Okay, I will get us started. Welcome to the JDC West 2021 Finance Case Competition, sponsored by CFA. Thank you to our judges, Rachel Ganadin, Manager of Business Markets at RBC, Brian Gilchrist, VP Finance at Pulse Canada, Stuart Hendrickson, CFO of Bold Commerce, Gita Tucker, President and CEO of CPA Manitoba, and Andre Cadieux, Manager of Corporate Finance at IG Wealth Management. Competitors will have a maximum of 20 minutes to present. Immediately following the presentation, judges will have a total of 5 minutes to ask presenters questions. I am your academic moderator who will be timekeeper and control overall flow of the presentation format. Time intervals will be noted in the Zoom chat by myself beginning at the 10-minute mark. Following the presentation, I will facilitate a Q&A period. Judges will indicate their intent to ask a question using the hand raised function, which I will call on them to indicate their next question. No questions or comments will be permitted from the audience at any time. The audience is also prohibited from communicating to the presenters in any forum, including Zoom or via other mediums during the presentation or questions. If you're an observer, please ensure your camera is off and your microphone is muted. Once the question period has completed, the Zoom meeting will end. Competitors, you're free to begin.
There's a reason why we love sport. It unites us. Regardless of how you play or experience sport, there's a sense of community and support created. Now more than ever, in a time where we've experienced what it's like to be separated, sports has been one of the few ways we've been able to stay connected. However, unlike the rest of the industry, the golfing industry in particular has seen high growth and popularity. Brian, you've created Dragonfire based on your personal love for golf. And now, as you approach retirement, you're unsure whether selling your business right now is the best decision. And that is why we are here today. Good afternoon. My name is Kadu, and I'm joined by Justin and Amanda. And we're so incredibly excited to be here today to present to you our recommendation regarding the future of your company. To begin, we'd like to outline our main objective, which is to determine whether selling this business is correct right now. And in order to accomplish this, we looked at various analysis points. The first being the industry in golf and in the sports industry. We then looked at the impacts of COVID-19. And finally, we conducted a financial evaluation of your company today. Our main recommendations for you is to sell your company at $11.9 million and to finance your various capital expenditures using debt financing. To begin our analysis, I'd like to begin with an overview of our issues today. The first and the most pressing one is determining whether you should be selling your business. Now, there are some secondary issues that we'd like to identify today, and these relate to the financing of the clubhouse maintenance, as well as maintaining or purchasing certain equipment that you need for the success of your golf course. And finally, we looked at some dividend payouts and how you can manage that moving forward. Diving deeper into our first analysis point, which is the cause of COVID-19 and how it's caused our margins to expand substantially in 2020. So as you can see here from the graph on the left, we've seen increases in our margins, primarily the biggest jumping from 2019 to 2020. And this is really because of more popularity within the golfing sector. There is a safer bet with social distancing, and this has really caused a lot of people to flock to golf courses. Now, of course, this isn't to say that this is going to be a constant trend, and there will be projected downward trending of margins following the 2021 year as the vaccine rolls out and people discover other forms of entertainment. Now, diving deeper into the industry of sports as a whole, we looked at a Deloitte case study here, and one of them really outlined what 2021 looks like for sport. And what we're really seeing is the impacts of COVID-19 and their impacts on the industry itself, whether it's just retailers or organizations, everyone is really feeling the impacts. And what this has really caused companies and firms to do is to look at alternate streams of revenue generation, primarily through leveraging technologies such as artificial intelligence or different ways of consuming sports media. Again, here in 2020, we've seen a lot of trends with diversity and inclusion within sport, and that is an important consideration for these sports organizations. Looking forward into the golfing industry specifically and looking at the aspects that dominate this market is One, we're seeing rising prices of cost drivers, whereas such as with the increase of inputs required to run your golf course. And of course, like I mentioned, there are some technological experiences that are disrupting this industry. Again, the golfing sector as a whole is heavily dependent on seasonality and the rise of socially distant activities posed by COVID-19. So how is the golf industry in Canada adapting to these changes? Now, they are adapting by uh, changing the fee structure of their golf course by offering those discounts. Now, because of the membership being quite a commitment for a lot of people to make, golf courses are now creating incentives by offering discounts and being more flexible with their fee structure to encourage people to be more involved with golfing as a whole. We are also seeing a lot of resale and repurposing of existing golf courses with either bigger residential areas and commercial areas, as well as just the shift to utilizing the venues rather than for sport. So our key takeaway here is that selling Dragonfire does, during this robust period of demand, prevent an attractive opportunity moving forward.
So now it is important to look at the supply chain for Dragonfire, and particularly some of the costs that are important to Dragonfire, with the first one being fertilizer. So with the recent blockades, these have actually led to a pent up in demand. For example, Nutrien had been suffering in their stock performance, but more recently we are projecting that supply is going to change, and therefore we still expect the cost to increase overall going forwards. As well as the labor wages, Ontario has seen a minimum wage increase in October of 2020 to 14.25, and this is going to be headed in the direction of increasing costs overall going forwards. The third cost relating to water. Since global warming is actually affecting our temperatures, this will in turn impact how much water is going to be used on average, especially in those warmer months. And the fourth cost relating to gas, as mowers are being used for the equipment. So the demand pressure from this as oil prices increase overall, especially given the fact that the vaccine will be initialized fairly soon, and this will impact car and air travel, leading to higher prices overall. So we can see here that the key insight is to prepare Dragonfire to sell, as costs will continue to grow in the future.
Great, now let's dive a little bit deeper into the financial analysis, and the key question of should Dragonfire sell is what price can we sell at? Now we're going to work through this with 3 steps. First of all, we're going to build an operating model where we forecasted the future operating performance based on various scenarios. We know that COVID-19 is a very unpredictable situation, and therefore we have 3 scenarios: a base case, a bull case, and a bear case. Secondly, we're going to take our operating model and use a discounted cash flow valuation. This is one of the most fundamental finance valuation methodologies that states that the value of an asset or a company is the present value of its expected future cash flows. There is a downfall to using a discounted cash flow valuation, though, as it relies on various assumptions. Number 1, the terminal value assumption, as well as number 2, the operating assumptions and the discount rate. Moving on to the third step here, our relative valuation is used to compare similar companies. Similar to if you were buying a house, you would look at other houses that were selling in the area, their square footage, their number of bedrooms, their location, and compare that to the price of the house that you're paying for. We can do the same thing with companies and infer the valuation of Dragonfire. However, we do know that no 2 companies are exactly alike, but by using 2 of these valuation methodologies, we can cover all bases and build in a margin of safety. Moving on to our operating model, this is our base case. So there are a lot of numbers out here, but the summary here is that 2020 was really an unprecedented year where the golf industry benefited substantially from COVID-19. As Kadu mentioned, social distancing led to golfing becoming a preferred choice of sport for a lot of people. However, on a long-term basis, we believe that operating conditions should normalize. And so we have a 5-year revenue CAGR of around 2.5% and a 5-year EBITDA CAGR of negative 4.1%, which is in line with the pre-COVID trend of EBITDA. Moving forward, looking a little bit deeper into our operating model, let's look at the margins first. So over the next couple of years, we have a slight margin uplift. However, as I mentioned, a normalization to pre-COVID levels. This is driven by a change in revenue mix, which is the second point there. We believe that shifting revenue mix towards alternative events instead of the golf operations should benefit the revenue mix going forward. And thirdly, increasing cost inflation from expectations of rising input costs, as Amanda mentioned earlier, will put downwards pressure on margins. Moving on now, we can see that the industry ROA average return on assets in 2019 was 10%. And although 2020 has been a very strong year for returns, we expect the return on assets to normalize over time. Now moving on to our discounted cash flow valuation. So what we did here is we took the net operating profit after tax, made the necessary adjustments, including adding depreciation and amortization and other non-cash expenses, and subtracting capital expenditures, including maintenance CapEx and expansion CapEx. And by discounting that at a WACC rate of 8%, we arrive at an enterprise value of $9.6 million. Adjusting for the net debt that Dragonfire is currently carrying, we arrive at an equity value of around $9.2 million. Our WACC rate of 8% reflects the low cost of debt from the record low interest rate environment that we currently are in. However, it is adjusted upwards slightly based on a liquidity premium and an equity risk premium. Our perpetual growth rate of 1.5% was derived from being in line with our long-term inflation expectations. Now, as I mentioned, we can't rely on only our base case. Because COVID-19 is such an unprecedented scenario, we have to come up with different scenarios of what might happen in the future. So our base case implies that the return to normal operating conditions will occur over time, and that we expect Dragonfire to pivot their revenue mix towards events as opposed to golfing, and that there will be slight cost inflation from the rising input costs that Amanda mentioned earlier. Diving into our bull case, we believe that revenue growth will be maintained as consumer preferences have shifted permanently after COVID-19. Maybe people that didn't like golfing before COVID, they've discovered a new passion for themselves. We also believe that there could be exit of competition from the industry as prices are inflated right now for businesses and valuations are higher. A lot of people may be looking to sell. And we expect that in our bull case, cost inflation will be less pronounced over time. In our bear case, we believe that consumer preferences could normalize to pre-COVID activities where the industry was stagnating. We could return back to those conditions. There also could be new entrants of competition to the industry given the strong operating performance of the industry in 2020. And also there could be excess cost inflation over time. And we can see the results of our three operating scenarios in the equity valuation on the right there. Moving on, let's look at the relative valuation. So at the top, we see the current listings of businesses of golf courses, and the price per hole averages at around $664,000. Looking at precedent transactions, we have the average price per hole at $3 million. However, that is skewed upwards by Unionville. And so we decided to use a median there. However, we'd like to shift focus to current listings as opposed to precedent transactions. Those precedent transactions took place in a time period before COVID and before the impacts that COVID may have on the future cash flows. So moving on to the next slide. We believe that looking at the current listings, the implied upside of these current listings are 29.7% over our base case valuation. And so we see a lot of upside to selling in the current environment. Now let's move on to the secondary issues. So there's three here. Number one, the clubhouse maintenance and how we're going to finance that. Number two, maintaining or purchasing current equipment. And number three, the dividend policy going forward. So let's dive straight into the clubhouse maintenance. So we need to finance HVAC, roof, resurfacing of entranceway and parking lot of our operations. And we have a few alternatives here. Number one, a line of credit that has a $50,000 limit. We also have a variable rate that is based on the prime rate plus 5%. and also a fixed non-revolving loan of 5.5%. We do note that prime rates are at multi-year lows, and the expectation of interest rates are to remain low. However, they could increase over time in the future. Fixed interest rates provide more visibility on future cash flows. And for that reason, our recommendation is to utilize the line of credit to its full amount of $50,000, as well as utilizing the non-revolving loan with a fixed interest rate of 5.5%. We believe this provides the most stability in future interest payments, as well as the lowest interest rate as well. Going forward, the fairway mower decision of maintaining or purchasing new equipment. I'll be brief here. We can see that the present value of keeping current equipment is lower than renting out or purchasing new equipment. And a lot of that comes from the new cost efficiencies that can be realized from purchasing new equipment, which leads to incremental cost savings of around $1,451. So we do recommend buying new equipment here. Moving forward to our dividend policy, we do recommend maintaining the current pre-COVID dividend policy, given the strong operational free cash flows that we're generating in 2020 and expected in 2021 and beyond. So given our key points of analysis, let's look at alternatives. So keeping the business, our advantage here is to shift the revenue model and focus on events and meetings. However, the disadvantages are that, again, the golf demand is not guaranteed to persist and that there could be higher input costs, as mentioned earlier. However, looking towards selling the business, now that you're approaching the age of retirement, this could set you up financially for a successful retirement. And the current environment with inflated valuations creates an opportunity for an attractive offer. Now that we've walked through our key points of analysis and alternatives, Amanda will now walk through our actionable recommendations.
Thank you, Justin. So our recommendation involves a PAR 3 strategy to sell the business. This will take advantage of the industry attractiveness at this point in time and to ensure that the company maintenance and equipment is functioning. So this will involve first selling Dragonfire and maintaining the dividend policy, followed by a certain mechanism to finance the clubhouse projects, and third of all, to purchase the new mower equipment. This in all will imply an upside of 29.7%. With the first recommendation being to sell the company and to maintain the dividend, the target selling price will be $11.9 million. Through conducting a share sale, as the share sale is more tax favorable compared to an asset sale, and also to maintain the annual dividend to current shareholders. This will allow you to have more financial freedom going forwards and also to pursue the attractive offer for buyers as our analysis supports. So here we can see the key impact is to take advantage of the opportunity to sell for $11.9 million pre-retirement. Our second recommendation are the financing options for the clubhouse maintenance, including the HVAC and roof replacements, as well as the entrance and parking lot resurfacing costing $100,000. This should be done through the lowest possible interest requirements, which include $50,000 through the line of credit at 3.5%, and then $50,000 through the non-revolving loan at 5.5%, to ensure that the company is well positioned for the sale and to reduce any risks that are associated with losing value on the property. So our key impact here is to position the company in the best possible place for resale through the lowest possible interest rate plans through these financing options. Our third recommendation is to purchase the new equipment. As Justin demonstrated in the financial analysis, purchasing the new equipment will imply a present value of $68,780. This will ensure that customer satisfaction is maintained in the process as they are going golfing, and who wouldn't want to ensure that they're golfing on the best lands possible. So here we can see our key impact is obtaining opportunity cost savings of $1,450 while ensuring that equipment is well functioning. With any great recommendation comes a suitable and impartial implementation plan. Kadu will walk you through the key steps now.
Thank you, Amanda. So right now, where we are in November 2020, there are a lot of things that need to be accomplished, but we have a strategy for you for that. So the first step would be for you to meet with your other shareholders and gain their interest. They do have a lot of say in big financial decisions, and this is something that you need for their support. Once you've gotten that support, you can then go ahead with listing your business for sale and going ahead with obtaining that line of credit at $100,000 in debt financing. Once you've established that, you can then go ahead with identifying and potential buyers for the golf club and beginning those repairs and resurfacing procedures. We want to make sure that this is a great clubhouse and well renovated in hopes for that successful sale. Once that's completed, we can then go ahead with the standard protocol for contracts and negotiating, drafting up sales contracts, and finally executing that contract by the end of Q1 in 2022 at $11.9 million. Of course, with any strategy, we do account for risk, and we've outlined two here today. The first is that the quick reopening of the economy leads to less golfing demand. And what you can do here in that situation is to shift your revenue mix towards events as opposed to golfing. Today, we had the objective of helping you determine whether your business was right for sale. And with our Part 3 strategy, we believe that selling your business will have an implied upside of over 29%. Thank you for your time, and we now would love to answer any questions.
Thank you very much. That concludes the presentation portion. I will open it up now for a 5-minute Q&A. Andre, do you want to get us started?
Sure thing. Great presentation. Thank you. One quick point of clarification first. The mower NPV, is that positive or negative 68,000?
Thank you for the question. That's actually a negative NPV as there's a cash outlay and then there's additional operating costs associated with maintaining that.
Okay, thank you. My question is, if you have a sale in 2022, does your present value of your DCF, does it factor the time difference between then and now? And do you think we're missing out on the opportunity to sell it high right now due to the COVID bump?
Right, so our discounted cash flow valuation is based on valuing the company as a going concern, based on operating the company as is, and how much we think the company is worth based on that. Again, there's a lot of uncertainty with what's going to happen in the future. And so we think that right now, with the golf industry at all-time highs, would represent a good opportunity to sell.
Thanks. We'll go to Rachel next.
Thank you. Going to be a similar question there to the previous one, but I'll follow up with this one. At the anticipated sale price of 11.9 million, it's quite a bit higher than previous offers. What do you think justifies that bump up in price?
Right, what we see that justifies this bump up as price is the current listings and their current prices based off of similar comparables. And we see that these similar comparables would justify this price going forwards.
We'll go to Stuart next.
Yeah, just one quote from your presentation. You said it was an unprecedented year, which of course we would all agree. But at the same time, you're noticing, you're stating there's a structural change. So in other words, revenue will continue to go up. So as opposed to post-COVID, there being a pullback like there was with the Tiger boom and other times, you're actually saying no, people keep golfing. I got to challenge that just because post-COVID, don't we expect there to be other alternatives for people to play contact sports and do other things? Like, wouldn't you expect some reduction in revenue?
Absolutely. So right now, COVID was special because everyone didn't really have a choice, and maybe they didn't like golfing before, but now that was an opportunity for them to try something new. And so we've been able to tap into a new base that we haven't really been able to initiate before. And based on that opportunity itself is why we projected the revenue growth as we did, the opportunity for an untapped market to now become realized.
Okay. Thank you. Geeta, we'll go to you next.
Great, thank you. So you mentioned in your implementation plan that one of the first steps you would do is to secure about $100,000 in debt financing. Why would you do that in an environment where you've got excess earnings in the year?
Thanks for the question. That's a great question. I think that given the strong operating free cash flows, internal financing would be an option. However, we want to lever up the returns by utilizing debt, especially at a time where interest rate environment is very low, and we can take advantage of very favorable interest rates. So for that reason, utilizing debt in this situation would actually increase our overall returns.
Thanks. We'll go to Brian for the next question.
Thanks. You had suggested that the sale is done as a share sale. So there's two other investors that are on board right now. Are you anticipating that they would join in and share and in that share sale so that the buyer would basically control 100%, or are you expecting that they would hold on, and would that impact the attractiveness of the organization to the buyer?
Absolutely. So right now, the other shareholders do have a 20%, a 10 to 20% stake in the company. Of course, right now, they're not really involved with the day-to-day decision-making of the golf club as is. And so we believe that even with a share sale, even if another buyer came in with a majority of control, that wouldn't necessarily be an adverse reaction on behalf of the shareholders.
Thank you. At that point, we will close question and answer. For today, I'd like to thank the competitors and judges for joining us. Competitors, you may log out of the Zoom.
On behalf of the team, we would like to say thank you to everyone and have a great rest of your Saturday.
Thanks, everybody.